This is based on a real-world example. It's just a very simple diagram, but this is from the 70s. If gold is going up, and if stocks or real estate, it was both stocks and real estate in the 70s, if gold is going up at a much faster rate, and it did during the 70s, stocks rose a little bit, but basically they were sort of bouncing along sideways. If you were invested in gold, when you sold 10 years later, you could buy many, many, many times more stock. But then one asset becomes too overvalued, the other one becomes too undervalued, and the cycle reverses, and it did for 20 years. Gold went down from 1980 to the year 2000, and stocks entered a bull market that was one of the greatest stock bull markets in history. And then it reversed again, and we're about halfway through this cycle right now. Now, if you take one asset class and divide it by the other asset class, what you discover is that everything is trapped in what I call a valuation range. And you can be invested in one thing for a very, very long time and end up nowhere. But if you can measure when something is overvalued and something else is undervalued, then you can sell the overvalued asset class and buy the undervalued asset class. And it's like busting these cycles apart and pasting the next wave onto the end of the last one. And it is a road to true wealth. I'll show you that in a moment. This is a upper middle class home, nice like 4-bedroom, large home, and that sold for about $3,000 in the 1920s. And gold was $20 an ounce back then, so it would have cost $3,000 or 150 ounces of gold. And then in the 30s, the house fell to $2,000. Gold was now $35 an ounce. If you had sold this house for $150 and bought gold, repurchased, you could have gotten 2.5 times the amount of real estate. Then in 1970, that house was now $30,000, but gold was still $35 an ounce, so it cost 850 ounces of gold. So if you had bought this home, the 2.5 times more real estate in the 30s, and then in the 70s sold for, when it was $30,000, 850 ounces of gold, you would have received 2,125 ounces of gold. Then just a decade later, the house was now $60,000. But gold became free trading in 1971, and it went from $35 an ounce up to $850. So that house was now worth 70 ounces of gold. It went down from 850 down to 70 during that period of time. So if you repurchased real estate with your 2,125 ounces worth of gold, you would have now gotten 30 of the same type of home that you sold in 1920, you would now own 30 of them. This sounds absurd, but these are just numbers. This is an exercise on what is a wealth cycle and how big is its power. But you can catch quite a bit of this wave just by looking at numbers and making the right decisions. Because this is the difference between price and value. That home went up in price constantly, but the value measured in gold went from 150 to 50 to 850 down to 70 to 800. So it was bouncing in that valuation range that I was talking about. Learn these things.